Imagine waking up to find $1 trillion has vanished from the global economy. For years, Chinese money poured into American businesses, from Hollywood studios to Wall Street giants. Then, overnight, Beijing slammed the door shut. No heads up, no middle ground, just a hard stop. American executives are reeling, trying to figure out what hit them. But this isn't just a policy change, it's a deliberate, calculated move in a high-stakes game that's moved beyond trade wars and tech battles into the realm of capital itself. The fallout? Layoffs, spiking prices, frozen 401ks, and a chilling reality. That money isn't just gone, it's being redirected elsewhere. So, why did China pull the plug on U.S. investments? And could this be the first step in something much bigger? Let's unpack what's happening and what it means for the future. China didn't make a big show of this. No press conference, no public statement. Instead, the Ministry of Commerce slipped in a rule change, labeling all non-essential capital flows to hostile jurisdictions, including the U.S., as suspended, effective immediately. Then, on March 17, 2025, a leaked directive from China's State Administration of Foreign Exchange doubled down, halting all outbound investments into U.S. firms, citing geopolitical risk and asset security. The news broke through regulatory filings, later confirmed by Reuters, and it's already sending shockwaves. The numbers tell a stark story. Chinese investment in the U.S. was already on life support, dropping over 95% from $46 billion in 2018 to just $2.3 billion last year, according to the Rhodium Group. Now, it's flatlined at zero. Professor Zha Daozhong from Peking University calls it a precision strike, designed to choke off capital to the U.S. without sparking immediate retaliation. This isn't about emotion, it's a cold, strategic play. The real kicker isn't just what China's blocking, it's where they're sending their money instead. This isn't a freeze, it's a pivot. Beijing's been quietly pulling back from U.S. economic exposure for years, and now they're redirecting those funds elsewhere. Think Asia, Africa, Europe, places where China's influence is growing, not shrinking. This could be the opening move in a financial siege, one that starves U.S. markets while fueling others. Trade might still limp along, but the bigger picture is clear. China's rewriting the rules of global finance, and they're playing for keeps. The immediate fallout is already hitting. Layoffs are spiking, prices are climbing, and retirement accounts are taking a hit. But the bigger question is, what comes next? If this is just the first move, the U.S. could face a prolonged economic squeeze with ripple effects across industries and markets. China's not just cutting off cash, they're reshaping the global financial map. For American businesses and workers, the message is clear. Adapt fast or get left behind. Imagine a faucet that's been pumping money into the U.S. economy for years suddenly turned off. In 2024, China sold off $14 billion in U.S. treasuries, their biggest dump since 2016, slashing their holdings to $775 billion. At the same time, Chinese state-owned banks started cutting off dollar-based transactions with U.S. banks, following strict new orders from the People's Bank of China. U.S. Commerce Secretary Gina Raimondo sounded the alarm in January. China's reshaping its financial ties in ways that are seriously undermining our leverage. The problem? America's usual tools, export bans, tariffs, are like trying to catch a speeding train on foot. Meanwhile, China's cozying up to Riyadh, Moscow, and even Brussels, where European companies are now pushing to dodge U.S. financial restrictions. The gap in leverage isn't just growing, it might already be too late to close. Foreign investment in the U.S. is drying up. According to UNCTAD, foreign direct investment dropped 22% in 2024, with early 2025 projections showing another 19% plunge. China's exit was the biggest blow, but it's not the only one. Norway's massive sovereign wealth fund yanked $7.1 billion from U.S. tech stocks, spooked by regulatory uncertainty. Japan's GPIF, the world's largest pension fund, slashed its U.S. commercial real estate holdings by 30% after Moody's downgraded several regional banks. With $4.1 trillion in U.S. corporate debt due by the end of 2026 and fewer foreign buyers to roll it over, American companies are stuck borrowing at home at much higher rates. This isn't just money leaving, it's a slow, tightening chokehold on the economy. The pain is hitting mid-tier businesses hardest. With traditional funding sources vanishing, companies are turning to risky, high-cost options. In 2024, U.S. firms issued over $430 billion in junk bonds, a 38% spike from the previous year, per Bloomberg. The average yield? A punishing 9.6%, nearly double the 5.2% from 2022. Take Hartwell Tech, a Boston-based manufacturer. They lost a $180 million Chinese-backed equity deal overnight when Beijing's investment freeze hit. Desperate, they turned to Apollo Global for emergency financing at a staggering 11.3% interest, putting their intellectual property and real estate on the line. Fitch Ratings now warns that 1 in 5 mid-sized U.S. firms faces serious refinancing risks in the next 18 months, as private lenders demand brutal terms. Many are being forced into survival mode financing, trading long-term stability just to keep the lights on. The promise of reshoring, bringing manufacturing back to the U.S., was supposed to be a shield against this kind of financial pressure. But with foreign capital fleeing and borrowing costs soaring, that dream is looking more like a mirage. Companies are caught in a vice: less access to funds, higher costs to borrow, and a global financial landscape that's shifting away from America's favor. If this trend continues, the squeeze could reshape the economy in ways we're only beginning to understand.
In 2025, President Trump signed an executive order pumping up tax credits for reshoring, hoping to supercharge American supply chains. It sounded like a win. Bring manufacturing home, create jobs, and stick it to global rivals. But the reality's messier. The National Association of Manufacturers says 62% of companies planning to expand in the U.S. are now staring down serious funding shortages, largely because foreign investors, especially from China and Taiwan, have vanished. Big projects, like an $8 billion battery plant in Michigan and a $3.1 billion robotics hub in Nevada, are either stalled or dead in the water. Even the CHIPS Act, billed as America's ticket to chip-making independence, is wobbling. Intel's $20 billion Ohio project just hit pause on its second phase due to funding woes. Economist Eswar Prasad put it bluntly to Bloomberg: without diverse capital, these projects are more symbolic than game-changing. As supply chains come home, costs are spiking, and the reshoring vision is running headlong into a harsh truth: there's not enough money to make it work. Trump's 2025 tariff push isn't helping. Tariffs now hit over $500 billion in Chinese imports, up from $370 billion in 2020, with an average rate of 22%, per the Peterson Institute. The result? Everyday goods, think electronics, appliances, and auto parts, are getting pricier. Appliance prices alone shot up 16.7% year over year by Q1 2025, according to the Bureau of Labor Statistics. Retail giants like Walmart and Target have sounded the alarm, issuing margin warnings for 2 straight quarters, blaming tariffs. The National Retail Federation estimates the average American household will shell out an extra $1,950 for goods by year's end. Companies are stuck in a bind: eat the costs and watch profits tank, or pass them on and risk killing demand. With real wages flat and inflation hovering above 3.6%, consumers are already stretched thin. S&P 500 earnings growth slowed to a measly 1.2% in Q4 2024, down from 4.5% the prior quarter, per the Wall Street Journal. The math isn't adding up. The bigger picture is even bleaker. The Economic Policy Uncertainty Index, developed by Baker, Bloom, and Davis, hit its highest level in over a decade in Q1 2025, worse than the 2008 financial crisis or the 2020 lockdowns. What's fueling it? A brutal mix of aggressive Federal Reserve tightening, erratic fiscal policies, and unpredictable trade sanctions, all colliding during a shaky global recovery. For businesses and consumers alike, it feels like the ground is shifting beneath their feet. The reshoring dream was supposed to bring stability, but without the cash to back it up, it's starting to look like a gamble. And as costs climb and uncertainty grows, the real pain may just be starting, especially for the consumers who don't yet see the storm coming.
Back in March, a troubling signal emerged. The CEO Confidence Index from the Conference Board dropped to just 37, its lowest point since mid-2020. Nearly 7 out of 10 executives said they're struggling to make long-term plans, not because of money, but because of political confusion. It's chaos, not cost. That's stalling progress. And investors are clearly paying attention. According to Bloomberg, more than $120 billion has flowed out of U.S. equity ETFs in just the last 3 months. That's not just a blip. It's a deeper crisis, one of trust. If America's allies start rethinking where they place that trust, Washington may not get to call the shots much longer. We're already seeing signs. Just after German Chancellor Friedrich Merz visited Beijing in February, chemical giant BASF announced it would double down on its $10 billion expansion in China. Around the same time, France's economy minister Bruno Le Maire signed a major LNG deal entirely in Chinese yuan, sidestepping the US dollar altogether. And it's not just isolated deals. The European Chamber of Commerce in China reported a 19% spike in European investment into Chinese industrial zones in early 2025. Their reason? Policy stability. Even Saudi Arabia is adjusting. It's pulling back from U.S. treasuries and diverting $27 billion into a new AI-focused fund with China and Singapore. As former IMF chief economist Kenneth Rogoff told the Financial Times, the U.S. isn't losing influence out of protest. Allies are simply protecting themselves from America's growing unpredictability. China isn't demanding loyalty. It's offering something more valuable: consistency. But that stability is part of a larger strategy. China's freeze on U.S. investments might not just be defensive, it could be phase 1 of a global play to redirect capital. In March, China's securities regulators announced they're fast-tracking foreign IPOs in Shanghai and Shenzhen. Already, 38 companies have listed in Q1, up 52% from the last quarter. Behind the scenes, China's sovereign wealth fund quietly added $19.4 billion in ASEAN debt, according to a leaked HSBC report. But perhaps the biggest shift of all? The digital yuan is now being used in SWIFT-like settlement systems in 13 countries, allowing trade to flow across borders without ever touching the dollar. As HSBC's Harold Wong put it, this isn't about killing the dollar overnight, it's about building enough options that the dollar is no longer the only option. With America's financial credibility under pressure, the biggest threat might not be a confrontation, it might be quiet inertia. And by the time Wall Street notices, the money could already be gone. Thanks for watching. Let us know what you think in the comments below. Did this topic blow your mind or spark some questions? Drop them in the comments section. We love hearing from you. If you enjoyed the content, please hit that like button, subscribe to our channel, and don't forget to tap the bell icon so you never miss an update. Catch you in the next one. Thanks for watching, and stay awesome.